What do you believe are the biggest misconceptions about value investing? Surely, as investors, we're all value investors.
No, I think we are, and I suppose the counter to that is, who would knowingly want to buy into invest in a company where they know that the shares are overvalued. So you say, value investing is a misnomer to a certain extent. I think probably the biggest misconception we would say about value investing is that it involves investing in what are essentially declining businesses. As we know, there's a huge amount of technological change out there at the moment. Many industries are being disrupted. I mean, almost challenge you to name a company that's not going through some sort of change within its industry or marketplace. But we think the misconception, as I say, is that value investors, almost by definition, invest in declining businesses. And I think what we would say is that yes, we recognise, of course, that a lot of companies out there do face some very significant challenges. But of course, we all believe we believe that in all cases, given enough time, that the companies can navigate the changes in their industries and return to long-term profits growth.
Value growth was the big debate of the last 18 months.
Yeah.
How has that paradigm shifted between the two styles?
The terms value and growth can be misleading, as
Yeah.
as we've already pointed out. Obviously, we all want to invest in an asset which is underpriced, essentially. Growth, likewise, is a label that can be misleading, isn't it? Because we love investing in growth companies. It's just we don't want to pay too much for them. And so if you not today, but if you go back a few years, we were absolutely invested in companies which you would now label as growth companies. So we had big holdings within Microsoft. It's just that at the time, if you go back to 2010, you could pay 10 times earnings for Microsoft. Today it's 35 times earnings. We like growth. We just don't want to overpay for it. But I suppose in the context of the stock market and the way that many define growth and value, the landscape has shifted quite meaningfully over the last 18 months. I mean, a company which operates in a stable industry, which has a high return on capital, which can deliver predictable and steady growth over time, should, of course, command a premium to a company which is in a capital-intensive industry, which is where profits are more sensitive to the state of the economy. Of course they should. You've just got to try and gauge how big that premium should be. And I think our observation would be, and this is really, really, I suppose, triggered by, it was there anyway, but really, I suppose, amplified by coronavirus. We would say that premium has just become way too large. So investors should always pay a premium for certainty or predictability, of course, because that makes us all feel comfortable. But you just got to be careful how big that premium is. We would say that premium is just way too large at the moment. And so, I suppose come back to Microsoft. Microsoft is a great business, but it's priced at between 30 and 40 times earnings.
Yeah.
Whereas companies which are, as I say, operate, they're not as high quality. They're more, let's say, capital intensive. They're more cyclical, but the discount is so enormous that we think the investment case for these companies is very strong. So these companies are trading on, in some cases, mid-single digit PEs. So not 35 times earnings, 8 times earnings, a quarter of the multiple. And we think that valuation differential is too big.
I remember listening to the Temple Bar webinar, and you said that if an investor had bought Microsoft in 2000, they'd have had to wait 16 years.
Yeah, exactly. That's a very, very good point.
Yeah.
So if you had, let's say, you'd been unlucky enough to walk into or invest in Microsoft at the very peak in 2000, at the height of the technology boom, I think you would have to wait 15 to 16 years to get your money back in capital terms, and for the share price to return to where it was in 2000. And just to be clear, nothing went wrong in the company. So you bought the company in 2000 thinking it's got excellent growth prospects, but you were right. The company, the profits between 2000 and 2015 more than doubled. It's just you paid the wrong price for it to start off with. And we wholeheartedly believe that is the mistake that many investors are making today. The companies are good, but it doesn't mean you can pay any price.
How have valuations and multiples changed over the 18 months, and have you noticed anything within those metrics that are quite unsettling?
Many stock markets of the world and many stocks and sectors are looking very highly valued today. And as I say, many stocks trading on price earnings ratios of 30 to 50 times or even higher. And in a way, that's not a surprise, is it? We've had, as a result of COVID, and obviously even pre-COVID, we've had enormous fiscal stimulus from governments who are obviously trying to keep economies moving in the face of coronavirus, and we've had enormous monetary stimulus. That has obviously pushed down yields everywhere. Obviously, look at what the yields available in the bond markets today. It's not surprising in that environment that maybe large parts of the market become relatively expensive when put in a historical context. The danger, of course, is that at some stage, who knows when, interest rates or monetary conditions have to start to normalize. So you've got to remind yourself, today, the central banks, despite the fact that the headline inflation numbers are running pretty hot at the moment, you've seen some of them, 4 to 6%. I think the UK's just come out at 4%, 4.3% today or something. The central banks are not only withdrawing stimulus, they're talking about reducing the rate at which they stimulate. Yeah. So in the US, tapering asset purchases, but they're not talking about withdrawing stimulus. As and if they get to that point, because let's say inflation proves to be more stubbornly high than they had expected, and interest rates have to start to go up, it is not unreasonable to expect that the very highly rated growth stocks, which have done so well in share price terms as a result of ultra low interest rates, start to give back some of that multiple expansion that they've seen in the last few years. So we would say that though investing in highly valued stocks today is a dangerous trade. Do you think,
and that aside, do you think there's a lot of speculation in these stocks as well?
Yes, we would say speculation is investment without a margin of safety in the form of a reasonable valuation. And so wherever you think that valuations are unreasonable, we think there is speculation, because you're basically what you're speculating on, what you're relying on, is that valuation multiples in those highly rated areas don't return to more normal levels. Clearly, a company on a P of 40 that returns to a more normal P of 20, and those are more normal levels of valuation. In the absence of significant profits growth, obviously sees its share price move down very significantly, and we think that investors are largely forgetting that at the moment.
Why is the UK an accommodative place for this strategy?
Brexit clearly injected a level of uncertainty, and what I think, and that was, I suppose, a catalyst for the de-rating of the UK market, which really started in 2016, 2017. Whatever your views on Brexit, it has now happened, and I think we can see that life does roughly carry on as it was. So we don't see that Brexit should continue to be a factor. I think you also need to think about the composition of the UK index. The UK index, I talked earlier, didn't I, about how capital-intensive industries, cyclical capital-intensive industries should command lower valuations. The UK has the UK index has some quite heavy weightings and some quite capital-intensive industry. Think about the big energy companies, the big mining companies, quite a big weighting in financials. And so, again, all other things being equal, the UK should carry a lower valuation. I think also amongst retail investors, I think probably there's been a move to try and reduce the home bias. I think perhaps retail investors they've come to the view that perhaps they've got too large a portion of their money invested in UK assets, and they've been trying to reduce that, and I think that's probably also depressed the valuation as well. But whatever the reasons, we are now at a point where, these things are always difficult to measure precisely, but the UK stands at a very, very significant discount to global markets generally, and on some measures it's between a 40 and a 50% discount. Again, history has shown that starting valuation is the best predictor of future returns.
Yeah.
And starting valuation and future returns are very strongly inversely correlated. You pay a high price, you get a mediocre return. You pay a low price, providing the assets you're buying are reasonable, pay a low price, you get a good investment return. Within the UK, in a world where valuations are high, within the UK is effectively a standout area of value at the moment.
The portfolio itself, how has it repositioned since the pandemic, and what are some of the big names now that are biggest holdings?
So we try and it's the old sort of cliche of fear and greed, and we think investors don't always behave rationally, and they do allow their emotions to drive their investment decisions, and that was no more clearly demonstrated than during the spring of last year, during when coronavirus really became a problem. It is not an exaggeration to say fear took over, and share prices, depending on which sector you happen to be in, but many share prices fell by 50% plus. Got to remember, when you buy a share, you're buying the claim on a very long-term stream of cash flows. So even if you, sort of 20, 30-year stream of cash flows, even if you wipe out profits in year 1, year 2 because of coronavirus, it doesn't make that much of a difference to the long-term value of the share. And yet share prices are falling by more than 50%. So our job is to basically stand back, take a deep breath, and basically buy into those companies which are being sold down to very low levels. And it's not dissimilar to what we saw in the financial crisis in 2008. And so we did move quite aggressively to try and take advantage of the opportunities that the market.
Yes, you have to. Yeah.
Exactly. And so we invested money in energy companies, materials, the banks, and some of the consumer services companies. And I think that we managed to buy into some reasonable businesses at some very distressed valuations.
I want to talk about the discount on the trust as well.
Yeah.
When I checked yesterday, it's about 8.8%.
Yeah.
How does that stand in line with the 5-year average? And do you think that rate is a good place for investors to get into?
Yes. So it's higher than the discount is higher than it has been on average in the last 5 years. Yes, we do. I mean, we do think it's a good opportunity. I mean, if I could give you some numbers, so the Temple Bar portfolio trades on a 2021, so this year's price earnings ratio of 9 times on average. Okay, and offers a dividend yield of close to 4%. Of course, if you're buying at an 8-9% discount, you're not buying on a P of 9, are you? You're buying on a P of just over 8. So again, just turn those over. A P of 8 is an earnings yield of 12. I mean, these are very, very attractive valuations that we think investors are being offered today.
Excellent. Nick, thanks so much for doing this. Thank you very much.
Thank you.